Hello, everyone. Look, I'm Candice, GM of Marketing at the AFA, and I'm delighted today to introduce you to a webinar from the team at iExtend. How does a policyholder qualify for the iExtend offer? Today, you'll hear from iExtend's Head of Risk, Ruth Keaney, and Head of Alliances, Mark Stubbings. As the Head of Risk, Ruth leads the risk assessment team, oversees research, education, and policy portfolio management. She is a highly experienced life insurance leader with 25 years of underwriting, claims, and risk management expertise in Ireland and Australia. Ruth holds diplomas in business and medical underwriting from the Chartered Insurance Institute of Great Britain. And before joining iExtend, Ruth was a management consultant for 8 years. She's been head of KPMG's claims and underwriting team and was formerly chief underwriter and head of underwriting strategic solutions at CBA. So I think Ruth is pretty qualified in this area. So welcome, Ruth. And Mark, who is well known to the AFA community, particularly in Queensland. We all love Mark. He's had a lengthy career in financial services across Australia and New Zealand. In particular, he's worked in a number of licensee, financial advice, and product provider roles. Recently, he spent 5 years at Sun Super and then a year at Aware Super, where he designed, launched, and further developed their respective offers to the IFA market. Mark is an accountant by profession and holds an MBA in a number of financial planning qualifications. He is also the state chair for the AFA in Queensland. Now, today's webinar will provide an understanding of the circumstances behind life insurance policies that qualify for the iExtend offer. Using studies, I think I'm echoing, sorry if that's annoying anyone. Using case studies, Ruth and Mark will use real-life scenarios to discuss how iExtend works in a flexible way with advisors to understand a policyholder's health conditions, changes in circumstances, and their needs, as well as their families. This session will run in an interactive way with Q&A throughout. Before we begin, I've just got to cover off a couple of webinar housekeeping slides. Mark, are you able to share those?
Done already.
Thanks so much. 1 hour of CPD will be available for everyone, and the details will be sent around to you all within the next week. As a webinar attendee, if you can remain on mute throughout the session, and Q&A, like the questions can be answered at the end of the presentation. If you can just please use the Zoom Q&A function, not the chat function, which sometimes happens. Now, look, that's it from me. So I want to, hand you over to the lovely Ruth and Mark. And thanks for hosting this important webinar today. Guys, over to you.
Thanks very much, Candice, and welcome everyone today. And Candice, again, very kind introductions. Thank you. Ruth, Keaney, and I are very pleased to be with you here again. Since the last webinar we ran, we've been working to make this session another very practical workshop around who would qualify for the iExtend offer. Now, I've got the agenda up on screen, but I'm going to summarise it, try and summarise it succinctly. In thinking about who qualifies for the iExtend offer, a lot of the answer to that question actually has its roots in the flexibility and foundations of long-term renewable term life insurance policies. And we'll talk to that during the course of today's sessions. iExtend's goal is to, 1, acquire part interest in an eligible policyholder's term life policy. 2, accept the ongoing financial risk on the co-owned portion of that life policy. And 3, eventually share the claim benefits with the beneficiaries of the policy. What else we'll talk about today will involve the policy and the health conditions that qualify and also don't, and how the advisor can help in establishing qualification for the iExtend offer. As was the case with the last webinar, we'll also talk through some real life case studies. So let's get restarted with a little bit of a recap of some of the highlights of our previous webinars. Okay, so just a bit of a recap. What are we trying to achieve at iExtend? Well, interestingly, we launched the business in April this year, and what we were intending to do was to fill a gap in the insurance market and to work with financial advisors and insurance providers. The objective of that was to ensure that policyholders could continue the valued relationship they had with advisors and insurers by accessing a flexible, innovative, and alternative insurance option. At the heart of our vision, which is obviously the center point of the slide here, at the heart of our vision is this idea, the notion of collaboration. It's a collaboration between the policyholder, the advisor, and the insurer. So obviously three really important parties to this. iExtend is a private company formed by a group of like-minded people who saw an opportunity to help life insurance policyholders by assisting them to retain an interest in their unaffordable, yet very valuable, life insurance cover. iExtend aims to give something back to policyholders who have value in their policy, but have decided to cancel or reduce their cover. But as I mentioned earlier, it's really important to have that collaboration with the advisor and the insurer as part of that. All right, why iExtend? iExtend provides an option to those who've committed to cancelling some or all of their life insurance cover and walking away from their policy. Basically, if need or affordability has become an issue for a policyholder, there's four options. First option being keep all the cover and continue to pay the premiums. Pretty obvious. Second option has been to reduce the cover and thereby reduce the premiums. Third option has been to transfer the commitment to loved ones. So in other words, get them to share the benefits, but also the premiums of the policy. Or the fourth option has been literally to cancel the policy and receive zero. iExtend has now introduced an alternative when that cancellation decision has been made. As advisors know, cancellations can occur for a number of reasons. Firstly, could be an aging clientele. Obviously, clients in that cohort are often faced with large increases in the premium cost of their life insurance. Obviously, as clients get older, they have competing priorities for income, their expense, which is obviously being inflated now by cost of living pressures, and also requirements for capital. A number of clients have been recovering for the last 2 years. A combination of COVID and natural disasters has made life a wee bit tough. In addition, a number of them are preparing for and transitioning to retirement. And hence there's some competing priorities around retirement lifestyle and expenditure. So this is where iExtend has introduced the idea of co-ownership. Quite simply, we assist selected policyholders to retain their policies at a mature age, where a combination of health and affordability has made it difficult for them to retain or replace their policy. The whole concept of co-owning with iExtend eliminates premium payments going forward on the co-owned portion, but still it provides a claim for the beneficiaries. We shouldn't also ignore the impact that life insurance cancellation or reductions have had on advisors. Obviously, cancellations, reductions can have a big impact on practice revenue. Currently, the lapse rate in the insurance market is 15%. It actually reduced during the COVID pandemic down to 13%, but it's now back up again to that 15%. This can have a marked effect on the value of an advisor's book in those affected age group categories. What I'm going to do is talk now a little bit about how iExtend works, and I'll get the opportunity to introduce Ruth into the conversation as well, because at the moment it's just about me. How good's that? Kidding. All right, so let's recap quickly on how the iExtend offer works. whilst we want people to retain obviously their life insurance policies, we understand that some will not be able to afford to retain the cover. iExtend obviously will assume the cost of future premiums to extend cover for eligible policyholders. If a qualifying client has elected to completely cancel their policy, iExtend will accept policy ownership and pay all future premiums, resulting in a zero cost outcome for the client on all co-owned policies. For this, iExtend will share a portion of future claim payments with the original owners on a sliding scale, and I'm introducing that sliding scale now. It's quite possible that the client will want to retain part of the insurance cover, so not make all of it subject to a co-ownership arrangement. So if a client chooses to retain some of the cover, they'll make the premium payments on that retained piece. Under these circumstances, if a claim occurs, the client receives 100% of the cover they've retained and a share of obviously the portion that they're co-owning with iExtend. So Ruth, what I might do is introduce you into the conversation now and put up that graph there. So maybe you could explain to the audience, why does the client's share of the claim reduce as the length of the policy increases?
Well, we're really not expecting to play in the short-term claims, however, we do understand that an unforeseen event could occur, and so we have structured the sliding scale to take that into consideration. And as we continue to pay premiums and our expenses, and that sliding scale reduces to that 10%. So it's set up really for the medium long term, the claim, and the 10% is the 10% of the current sum insured.
Yeah, and you make a very good point there, Ruth, because it's the indexed amount. So it's expressed as a percentage. The index amount increases, so obviously the proportion increases as well. Thanks for that, Ruth. Thank you. What I'll do now is feed into a bit of a discussion around our target market. Target market is a question that we often get asked, so we'll flesh that out a wee bit as part of the recap. So this is what I'm going to do is in this slide here is actually draw up a bit of a visual explanation of who might qualify for the offer. But Ruth, as I sort of flick through the parts, could I get you to walk us and the audience through this slide?
Sure, Mark. So we've designed and simplified a score of 0 to 10 to show the life insurance market, and typically 0 being a healthy life, a standard rates life, we call it life insurance, and then at the other end of the scale, the 9 and 10, you know, a policyholder in very poor health and quite serious, if not terminal. So that's what that's our starting point.
Okay. Now, once we've established that scale there, Ruth, do you want to talk a little bit more about how people within that scale would rate in terms of cover at standard rates or otherwise?
Yeah, well, in life insurance, we typically see people at a younger age, often between the ages of, when they apply for cover, between the ages of 25 to 55, and in reasonably good health. So the 0 to 4 is really for those people in good to excellent health, reasonable health, or may have some mild chronic health conditions. And the 9 to 10, again, those that are seriously ill and may have a longevity or life expectancy of possibly on average of less than 5 years. And we believe that advisors, policyholders and their families should really do everything to keep their cover in the 9s and 10s. So this is not our target market. Okay.
So what I'll do, Ruth, is I'm going to put up a little graph there, which shows sort of the a little what you've spoken about in the graphic form. Do you want to put that in the context of the graph, the explanation?
Yeah, sure, Mark. If you just want to click the little yellow button there, Mark, so in a scale of 0 to 10, would say 0 being standard rates. This is where we see the life insurance market between that 0 and 5, maybe touching on 5. And where we see the gap is actually at an older age, where we have mature policyholders, typically in their 60s, but we're not hard and fast on that, because we do see people that are sitting in that score of 5 to 8 that have chronic illness that are under 60. So this is where we see the opportunity where we can support policyholders committed to cancelling in our target audience here.
Cool. And I think that's a very good sort of graphic demonstration. It gives a very clear idea of our target market. And again, just to reinforce that that starting point is when the client's actually committed to cancelling their life insurance cover. Okay, so that was a quick recap of some of the substance of our last webinars. But what I want to do now is really sort of start to anchor our conversation in that theme around the flexibility that's actually built into life insurances. Now, as we all know, life insurance is usually taken out in the beginning for a pretty compelling reason. And on the slide here, I've got an example of a gentleman called John, 64 years of age. And John has had some key person insurance for his business. And the business has now been sold. So John has actually decided to cancel that life insurance cover that was previously used for that key person circumstances. But on having a look at John's situation, John's advisor suggests another option might be available, which is the iExtend, an alternative to cancellation. And it comes to that idea that in actual fact, you can often repurpose life insurance. So the original justification in this example was key man insurance. It's now gone, that reason. However, with changed health conditions for John, there remains significant value in actually retaining that life insurance cover for his beneficiaries. So in prospect, we can actually repurpose that insurance by transferring the cover to John out of the business ownership situation. Ruth, you come across these sort of repurposing examples pretty frequently. Are there any other common examples of repurposing life insurance that you frequently come across?
We've certainly seen some in John's situation coming to that age of retirement and having chronic health conditions and committed to cancelling. But another common scenario we do see is changing family circumstances, where a divorce from a spouse or partner, and whether it's a joint life policy or a single life policy, it's at that stage where the advisor circumstances is they're committed to cancelling because of that change in client's circumstances. So not always health circumstances, actually a change in the family setup, and where the original policy may have had the beneficiary as the previous spouse, and wanting to review that, and is a common enough scenario we're actually seeing as well.
Interesting. That's and that would unfortunately, Ruth, be a fairly common thing these days, yeah?
I think particularly when the policies are joint. When I say joint, they're not on life of another, but they are bundled together into one policy, and so the advisor situation is important there, and they're often at that stage both family members are committed to cancelling. But I will cover it off in one of our real life scenario we had just a couple of weeks ago later. Excellent.
All right, so if we start to talk about this, the concept of unlocking that flexibility, altering the policy ownership. So how do we break out this flexibility, particularly if insurance is locked in, say, structures such as SMSF or in a business insurance arrangement? Hey, Ruth, could you sort of take us through what we need to do to get insurance out of those sort of sets of circumstances, all the different circumstances there are, and get it into effectively individual ownership. Yeah.
Sure, Mark. Well, essentially, it's an alteration of the policy. So the policy construct doesn't change in any form. It's more related to the policy ownership. So the first and most important thing for our policyholders committed to cancelling is they need to be an individual policy. They need to own that policy themselves. Right. So as we know in superannuation, it's been highly tax effective, and there are a lot of our policyholders that actually have an SMF or arrangement, or key person, but mainly SMSF. And so the process typically is, and insurers do vary, so but typically it's a memorandum of transfer is completed, and that actually moves the policy from the super ownership to the individual. And once that's done, then we are able to process that for qualifying policyholders. So the next step then is how do we move that then to our custodian perpetual, and that happens in the finalisation process, and that is another form of alteration as well. So it's a two-step process. Typically the policy is a new policy number. Premiums again typically stay the same. Sometimes they're a little bit lower or a little bit higher, so we factor that in. So it's essentially a policy alteration.
Cool, thanks, Ruth. Now we might just chat through that flexibility is really, really good, but we need to sort of make it, to realise it, to bring it to fruition. And this slide that I've put up here talks about that qualification process, and we've built that around insurance to demonstrate that flexibility. So Ruth, you were hugely responsible for this infographic. Would you like to sort of walk us through some of the key parts there?
Thanks, Mark. Yes, this is really encapsulates our qualification process, but also really importantly is the role of the advisor. So the advisor is front and centre throughout this process, and those touch points start at the very beginning. So the advisor has registered on the iExtend portal and has access to our pre-assessment tools, our education on the offer, and a quick quiz to test their skills and or their knowledge of the iExtend offer. So there's a lot contained in that space, but it all starts digitally and enabled digitally. So the advisor goes into the website and logs in once they've registered and has access to our tools there. And that allows the advisor to actually do a pre-assessment. So we call it, in our step 2, we call it a quick calc, and that's really essentially 3 questions. And that's really to test if his policyholder might qualify. So we've kept it nice and straightforward and easy and as plain English as we can. So when we were designing this, we had it in mind. We needed to make sure that the pre-assessment was advisor friendly, but also there were prompts there so the advisor could get as accurate as they could an assessment. But I think the main thing for the advisors is having an understanding, a good understanding of their policyholders' health, being quite important. Important to understand whether they qualify or not. And after that is done, which typically takes 2 or 3 minutes, and a real-time email goes to the advisor and also to our team here at iExtend. So it is real-time, it is self-directed 24/7, so the advisor can test eligibility. Then moving on, working with the iExtend distribution manager. At this stage, we're actually able to assign your local distribution manager to the advisor as well. So it's an important step to get all these parties together. Yeah. And the role of the distribution manager, again, facilitating and supporting the advisor with more information and more details on iExtend is critical there. So it's really, now we have the distribution manager working closely with the advisor. The third step, and again, this is self-directed as well, is continuing from the quick calc some more up-to-date information, policy information, health information. And this is really the engine room of the pre-assessment. This is really where we can drive some good accuracy into the pre-assessment decision. So, and it's also the advisor can, at that stage, they put in the amount the policyholder may wish to keep, hold on to, versus all of the sum insured. So there's flexibility there where you can choose a sum insured. So for instance, a policyholder wishes to, at point of cancellation, wishes to keep, has say 1.5 million cover and wishes to keep 500,000 themselves and co-own the balance, the 1 million with iExtend. So the calculator allows you to do that, and it generates the premium as well at the same time. So it's doing a few things for you. It's looking at the individual circumstances of the policyholder, the life insured. It's looking at the health circumstances. And I think importantly is we're application free. So this can all be done online. So we don't require signatures. And so that continuous assessment is really like an application, but it's signature free. And we don't ask for signatures. We don't think they're necessary unless the policyholder it proceeds and is eligible to progress to the final stages. So that's a really, really important opportunity for the advisor to get a really well assessed pre-assessment and a good indicative decision whether to proceed. And Mark, what I find is a lot of advisors, or not quite a few advisors, particularly if they're moving it out from super to non-super, will really want to get assurance that their policyholder is likely to qualify. Right. So this is really about, think about it, this is about speed. The policyholder is committed to cancelling. So we're not like a life insurer, we just don't have that time. So speed is of the essence, but also clear questions, plain English, very important, so that the advisor can, who knows the client best, can actually have that conversation with his client and gather that information. So we really want the advisor to drive that through. I come into the next part, which is the health information, and this is where we validate, and part of our sustainability, to make sure that we've got enough information to make that decision. These are often large policies. We don't ask for any invasive tests. I think that's really important. So there's no blood tests, there's no medical examination. We simply ask for a copy of the records, and we don't go fishing or anything like that. So within the last 5 years is quite acceptable for us. And that gives us a clear indication of the current health status of the policyholder. Sometimes policyholders have copies of their pathology or hospital reports. And again, we're showing flexibility here, where if they have, or if they can obtain them, we'd gladly have a look at them and see can we make decisions on that information. Another area where we look at is tele-interviewing, and if we need to have a tele-interview with the client, we can do that. So this is where I work. My team and I work to provide that technical expertise, and with our operational team here, we look to fast track that policy to the final stage, which is the 5th stage, which is the gathering of the paperwork for the co-ownership arrangement. And as we discussed in the previous slide, working with and providing hands-on support to the advisor in completing the memorandum of transfer. Sometimes it's a cancel and replacement, but it is the alteration information to allow us to onboard the policy. So that's it in a nutshell. They are the five steps.
That's a very good explanation, Ruth, of that onboarding journey. Thanks for that. Now, ladies and gentlemen, I think it's probably opportune to go into case study mode. And we've got 3 real life situations that we've been dealing with. So Ruth and I will tag team through this. But the first one is a 77-year-old female that we'll call Marie. Maybe, Ruth, I can just get you to start off with just running us quickly through the client's circumstances, yeah?
Sure. So Marie is currently 77 years of age. She's at the older age, and she took out her policy in her late 50s, just touching on 60, and she was accepted at standard rate. So in respect of her change of health situation, 6 years after taking the policy out, she developed type 2 diabetes, which is not uncommon in the older ages. And in 2019, this is where her real health challenges occurred. She experienced a major stroke with some residual impacts to her mobility. She had some speech impairment and some paralysis on the left side of her body. But other than that, she hasn't progressed any further, but she did have that permanent residue.
Okay. What was so that's a good segue. How did the advisor get involved? What was the advisor's role from this point on, Ruth?
Well, I think, again, she was committed to cancelling, and the policy was in lapse. And this is not unusual, where we see cases where the policy premium has not been paid, particularly monthly premiums. And so the advisor fortunately knew Marie well, and had been a long-standing advisor. So he had a good understanding of her health, and he went into our portal, our iExtend portal, to test her eligibility. So the steps he followed the quick calc, and he put in the information on Marie's stroke event, and her moderate event, and her diabetes. He also took that extra proactive step and downloaded our 4 or 5 questions on specifically on stroke and diabetes. So when he called Marie, which he did, he was able to ask her the right questions, and I think that really helped. And he then went and continued the pre-assessment with that information, with that up-to-date information. We were all on alert, because once you complete the pre-assessment, it is real time, 24/7. So the email goes directly to the advisor, but it also went to our distribution manager and went to my team as well. So we were all on alert, and we were able to progress this.
Okay, so obviously the next bit is that risk assessment piece, Ruth, where you have where you work through that, and obviously reach an outcome. So could I get you to chat through what the risk assessment and the outcome involved? Yeah. Sure.
Well, I think the first and foremost, again, the commitment to cancer, but it's also a commitment to getting privacy and medical authority consent. So that's really, really important before we go anywhere, and that we have permission to risk assess. And we find in the majority of cases, DocuSign, we use DocuSign. So very few wet signatures these days. And it's quite interesting, actually. We found older people are loving DocuSign. I don't know whether it's post-COVID or what it is, but it's certainly not an ageism. And really, she hadn't done it before, but she loved the DocuSign. So, and that means it's routed straight back to us as well. So Marie didn't have any pathology reports. So we requested a copy of her records from her GP, her long-standing GP, which was great. And we were able to finalise. And once we had that health records, we were to move very, very quickly. So, and we were able to complete that in the next 10 days.
Okay, that's a sensational bit of work. 2 questions coming out of that, Ruth, that we talked about that target market a wee bit earlier, and we looked at that graph and where our sweet spot was, for want of a better description. How did Marie score in terms of that target market scale?
That's a good question. So Marie, when she took out her policy, was between a 0 and a 1 on the longevity score. So again, younger age, in reasonably to good health. And however, all those years later, Marie has moved into our target audience, which is somebody that is experiencing chronic health conditions, and so she's quite, she's quite advanced in age as well. So we rated her longevity at around the 6 mark.
Right.
So when you think of our scale, 1 to 10, we're between 5 and 8. And as you age, that doesn't necessarily mean you're at a higher end of the scale. We have to calibrate it for the age, as we look at her continued life expectancy. So she was sitting in a 6.
Right, interesting. And look, the other obvious question is, having regards to Marie's condition, her health condition, and also her age, one's tempted to say, look, she might be a little bit vulnerable, if I could use that word that's obviously become quite frequently used. First of all, was that at the forefront of your considerations? And secondly, if it was, what sort of safeguards did you have there, Ruth, to sort of deal with that vulnerability? Yeah.
Well, I think we have to assume people with chronic health at an older age are potentially vulnerable. Yeah. And at iExtend, our team, we take that position that and we go to that extra level to communicate the way Marie and her family want to be communicated with as well. And we think it's really, really important to look at the individual circumstances of Marie, look at her age, look at her health. She has mobility concerns following the stroke as well. So that was really important for us. And we took a step, and we do that with all cases where we are potentially vulnerable. We are on the side of vulnerability. And myself and our head of compliance conducted a video, and we were able to bring in her spouse and her advisor at that stage. So that's something we are committed to doing for cases, particularly at an older age, because we need to understand what type of communication that Marie prefers, but also that we're listening, and we have the right subject matter expertise to answer any questions she or her family have, and to clarify anything, particularly in the co-ownership arrangement. So that's the extra step we took with Marie.
That's very comprehensive. So thanks for that answer, Ruth. Go on to our next, and this is a gentleman by the name of Patrick. And perhaps I could get you to, again, talk a little bit through this Patrick's circumstances, Ruth, just to set the scene. Yeah.
Thanks, Mark. Yeah, this came over my desk 2 weeks ago. So Patrick has had a joint life policy, and he's 62. He's got 1.1 million and indexed at 3%. He's got life and TPD cover. A lot going on in this policy. So he also has a 50% health loading, and that was due, we believe, looking at his height and weight, his BMI, and he was at that time was diagnosed early with diabetes as well. So it's not uncommon, when you're underwritten at that point, if you have those early conditions, that a loading might apply to the policy.
Right. Okay. Interesting. Yeah.
So the advisor circumstances was also interesting. So at the point of cancellation, the advisor confirmed to us that actually both Patrick and his wife, that he was putting both of those policyholders through our pre-assessment calculator, and due to Patrick having developed chronic health conditions, he got an outcome that he might qualify. And his wife's in excellent to good health, so she didn't qualify. And
so next bit is obviously the risk assessment, Ruth. So how did that play out when you worked your way through that?
Yeah, well, Patrick fortunately had a copy of his pathology report. So Patrick in the last 5 years, approximately 5 years, had a prostate cancer. And he had radiotherapy, and he was treated 100%. And he's been fortunately, he's been in remission for the last for almost 5 years as well. He's has diabetes, and his blood sugar level is 5.8, which suggests very good to excellent control of his blood sugar. And importantly, he's lost some weight. So you can see the change in health circumstances through many years later.
Yeah.
So,
and how did that play out to conclusion, Ruth? What was the outcome?
well, this is interesting. And so our risk team, we look at longevity, and we're looking at his changed health. And the most important thing we have to determine is that impacting his longevity? So Michael had a history of prostate cancer on a Gleason score, which is a pathology score of 2. So that's quite a low grade prostate cancer, and he has been successfully treated. So there was one area where he was fortunate to have it picked up early and fortunate to have it treated. And his diabetes gone from well established, and actually with his weight, and they often say with diabetes, losing 10 to 15% of weight can reverse type 2 diabetes.
Right.
So it looks like the last couple of years from that his diabetes has come back into a normal level, and a normal or almost normal level.
Okay. A couple of technical questions, Ruth. Gleason score. I'm assuming a big score's worse, low score's better. Do you want to just quickly touch on that? Yeah, well, just firstly, prostate cancer, of all the cancers, we have wonderful health screening in Australia. So we do at a global level, we pick up one of the highest percentages of incidence of prostate cancer. But also we also have one of the highest cure rates to prostate cancer as well. So, so the Gleason scoring is a universal scoring for prostate cancer, and it ranges from you might have benign prostate tumor, which has a 0 score, and right up to 9, coming on 10. So the Gleason scoring is very important. It tells us whether the severity, whether it's very mild and treatable, right up to a more advanced tumor. So yeah, so you're right, Mark. It goes from that lower end up to the higher end. Right. And again, back to our target market scale, where would the client have scored on that scale, Ruth? Yeah.
Well, this is interesting. If we'd probably seen this 5 years ago, where he was just having treatment, we might have had a different view. But we're looking at it at a later stage, and typically patients with the Gleason score of 2 would get standard rates if they were underwritten for life insurance today.
Wow.
So yeah, so it's not all doom and gloom, and he was very fortunate to have that treatment. His diabetes, again, it's age onset, and also the level is quite low. So if you look at what is a higher level of diabetes, it's between 7, 8 and upwards. So quite low, and fortunately some weight loss. So back when he took out his policy, let's say, the 50%, he was probably sitting around the 3 mark, the 2 to 3 mark.
Yeah.
But fortunately, believe it or not, today, with the quality of treatment and with prostate cancer being, at that stage being almost 100% cure rate, he's coming in between 1 and 2.
Wow.
Yes.
So Ruth, am I drawing too long a bow to say, hey, look, the quality of the assessment that you guys did and the information that was tendered, does it give the advisor the opportunity to go back to the existing insurer and negotiate around the loading? Is that a distinct possibility?
Oh, for sure. The advisor has done all the hard work. Let's think about it. They've done the pre-assessment, they've gathered the information, they've got a telehealth, they've got a pathology. So they've really got everything to go back to the insurer. And I actually wrote to the advisor to say, you may choose to, without giving advice, we don't give advice, you may choose to talk to your insurer again. There might be a possibility that you could get standard rates.
Right.
So it's not, it's hopefully a good outcome for the advisor. Yeah.
So in other words, you could have the really fortuitous situation of being able to negotiate with the existing insurer around the loading, or if that's unsuccessful, to actually rebroke the business at potentially standard rates, Ruth. Yeah.
Well, certainly for the insurer, absolutely. It's really up to the advisor. But if there's older, if the premium is an older product and there's more contemporary opportunity with that insurer as well. So I think going back to the insurer was what the advisor did in this stage, to have it reviewed and had all the information. And so he was able to repurpose that as well.
That sounds like a really brilliant set of outcomes on that one, Ruth. Very, very good. Through to our final case study, we've got a client, John, here. Ruth, perhaps I can just get you to talk through client circumstances and the advisor's role initially, just to set the scene before we look at the health and outcome. Yeah. Sure.
Well, 12 years ago, John was underwritten for cover. Today's some insurers 1.7 million, and it's much higher today with the 5% indexation. He was underwritten, and it's not uncommon for people to be on treatment for blood pressure and for cholesterol. He's in the mild obesity score. But fortunately, he was able to get standard rates back in 2010.
Okay. And obviously, what's the advisor role? Because John's looking to cancel his business insurance now. So how did that play out into the health circumstances, your examination of the health circumstances, Ruth?
Well, I think at point of cancellation, it's very important. We need to see if there's been a change in health, and that is our target audience between that 5 and 8. So John has developed obstructive sleep apnea, which is not uncommon, and has mild heart disease. He also he's heavier. He's a BMI of 35. So it's interesting when you look, like none of us have a deep understanding, but changes can occur with age, and we call it underwriting the metabolic syndrome. So in 2010, he had cholesterol, blood pressure, and overweight, and it's like a cluster of conditions, albeit it was quite mild, and he was lucky to get standard rates. However, as time passed, those conditions carried forward into a mature age, and he's developed sleep apnea and heart disease. So the change of health. So he was really sitting at the 1 to 2 at the beginning in 2010, but now has progressed into some chronic health conditions, and again around that 6 mark.
Right. And how did that play out in terms of an outcome? Yeah.
Yeah, well, he did fit our target audience market. So with the memorandum of transfer, we were able to move that into an individual policy, and progress it forward.
Excellent. Now, just out of interest, Ruth, relating it back to that target market scale again, how did he score on that target market scale?
He was coming in at the 6. He was coming at the 6.
Wow.
Okay. And look, it is mature age. It's mature age. Chronic conditions, mild or severe, occur at that age. So, and that's where we see the gap in the market. As they get older, they're moving into a different phase of life. And for some, with these conditions, become more progressive.
Right, that's excellent. Well, they were 3 really good case studies, Ruth. And I'm mindful of time ticking on, so I might flick now to draw the audience's attention to probably the top 5 takeouts from today. That 5 very strong themes out of the case studies is, number 1, and the preeminent one, is that we've got a commitment to cancel by the client. And also, as Ruth chatted through that second point there, we need to obviously have the ownership ultimately sitting in individual ownership to be able to deal with the policy. From understanding who actually qualifies for the offer, we obviously need to have yearly renewable terms. So that's the style of policy. And as we both most know, they usually go through to age 99. We need the individual ownership, as mentioned in the second point there. But also, very importantly, we need that chronic health condition, which Ruth has touched on quite a bit. And we can contrast chronic with manageable. Manageable means it's sort of kept in check or can be improved. Chronic, obviously, there's not the prospect of the health improving. Fourth point there is the reassessment opportunity. Are we actually be able to create some value for the client so that, as was mentioned in the second case there, actual reassessment from an insurance point of view of healthy lives, but also any rebroking opportunity where you have an old policy at an older premium rate versus a more contemporary policy at a newer premium rate. Is there the opportunity to shift from an old to a new policy with the consequent premium saving? And fifth point is around, we've obviously built a portal, and Ruth spoke about that at length, that it is a 5-step journey and it is significantly digitally enabled. And also we have pre-assessment tools that are available to the advisor in real time, 24/7, to access to help with the assessment of the case. Right, so those are the top 5 takeouts. So what's next? Obviously one of the best opportunities is to actually register on our website, and as a consequence, we'll assign you a distribution manager, and we'll obviously give access to the pre-assessment tools. iExtend is going to have a heavy involvement of the upcoming AFA conference, and we're pretty excited about that. So we've got an expo stand, we've got a Meet the Professional session, which we're involved in. We'll obviously be front and centre at the gala dinner, and there'll be quite a few members of our team who will physically be at the event as well. We also have representatives in all our states, so we're very happy, obviously, to share the name of our distribution manager and broker an introduction. Now, time is not our friend, so I might pause there and pass back over to Candice, just to see whether there's any questions that we can answer, Candice, in the short time left.
Thanks, Mark, and thanks, Ruth. Both of you, that was a wonderfully informative session about the iExtend offering and really options, great options for policyholders, particularly with aging and as our bodies fall apart, as they seem to. I can attest to that. Now, look, just quickly on questions, we've got a question in from Anita saying, Mark, can I please clarify, why don't you buy 100% of the policy? From the client's perspective, why would they go through all of that process rather than just reducing cover? What is in it for them? Actually, I think there's 3 questions here. And what's in it for the advisor other than just continued communications, if anything?
Yeah, it's a really good question. And look, it's often we do take the policy in its entirety, but often the client wants to have a proportion of that. So we leave that option open, that the client can choose to retain some of that cover or alternatively give us the entirety of the cover. So there's a fair bit of flexibility there, Anita, as to what the client wants to do. But to answer your question, yes, we can take the entire policy if you wish. From the advisor's point of view, and this is a very important point, the policy remains in force. So as a consequence, there is a continuation of renewal commission for the term of the policy which is now going to be in force until something unfortunately happens to the client. Yeah. So there's a quick answer, Anita, but we're obviously happy to chat that through further with you if you wish. Yeah.
Fantastic. Thanks, Mark. Look, another question. Can the policyholder change beneficiaries?
Yeah, good question. And the short answer is yes. They've got the ability to be able to change the beneficiaries at a particular point in time they wish to. So absolutely open, and that facility is available. Candice, yeah?
Okay, terrific. Thanks, Mark. Look, another one that's come in is, look, as a policyholder, can I keep just part of my cover? You know, how flexible is this iExtend offer?
Yeah. That really sort of dips into the answer to that first one, Candice, that yes, they can. So let's take a simple example. Let's assume that the insurance cover is $1 million. The policy sum insured is $1 million. The client might say to us, look, I'd like to hang on to 500,000 or 200,000 or 300,000, whichever is the right sum for them. They're quite entitled to do that. And the bit that they hang on to, we would call the retained cover. They pay for that.
Yeah.
And the bit that we take over is what we refer to as the co-owned cover. And we pay for that in its entirety, while still ensuring that their beneficiaries get a share of that co-owned cover, in addition to 100% of the retained cover which they're paying for. Yeah.
And yeah. I think Candice as well, they can actually further reduce that, you know, maybe at renewals again, and it's becoming unaffordable. Even that portion that they've kept, they can continue to dial that down and reduce it. We have that flexibility at renewal or at any stage.
Yes. Although Anita's come back and said, look, what is the advantage in selling all or part of their cover to iExtend? Like, what's in it for the client? Why wouldn't they just reduce or cancel and not put themselves through this qualification process? Is it onerous, I guess?
It's a good question. And no, it's not onerous, Candice. I guess that probably what lies at the heart of it is that if the client cancels the policy, they get zero. Yeah. Sure, they reduce their premiums to zero, but they also get nothing back from the policy, in which they probably have some value, right? By giving it to us, we pay the premium, so we assume we take it in its entirety. If we take the policy over, we pay the premiums from that point of time onwards. So it deals with the affordability issue from the client's point of view. But they are always staked a certain proportion in that policy as an entitlement for their beneficiaries. So it's a decision between surrendering, getting zero, and passing to iExtend and getting something. I don't think that's a difficult decision to make, given that the process of acquiring is not onerous. Yeah?
Yeah. Okay, thanks.
Pleasure.
Mark, for that. Look, just one final one before we switch off. Look, around vulnerable clients, you know, and everybody as they're getting older is more so, you know, as an advisor, you've really got to sort of look after these clients. You know, is there a change in how you support them and how you communicate with them?
Yeah.
Oh, Candice, absolutely. And we take that very seriously. So we sort of have 4 principles that we work through. How we communicate. Is it the way that a vulnerable person wants to be communicated with? Now, whether that's verbal, phone, writing, email, just be flexible there, particularly when somebody's getting older or has infirmed. The other one is we've got the right people to answer and clarify any questions in plain English for that vulnerable person, and listening to the questions that are asked, so that they really understand the offering, and their families. We really encourage beneficiaries or their loved ones or a close family member to also attend any tele interview that we have, or tele discussion, as well as the advisor. So it's very important that we create a positive experience, particularly at a vulnerable stage. And we don't always understand vulnerability, but vulnerability could be unaffordability, it could be health, it could be age, you know, it could be a range of a myriad of things. And so we really pay close attention throughout the process. And I think working so closely with the advisor is so important, because that advisor is there at the front of the centre and understands his or her client so well. And that's key to what we do, Candice.
Good point. Very good point.
Oh, excellent, Ruth. Thank you. Look, it is midday. I think we'll have to call it a day. But look, thank you so much, Ruth and Mark. I could listen to Ruth all day with her lovely accent. And but look, there were.
What about mine? What about
yours
mine,
too,
Candice?
There were, you know, some probably further questions that many of you, I'm sure, have. So please feel free to reach out to Mark and Ruth and the team at iExtend. You know, great team there to answer all your questions and to work with closely, you know, in this area of insurance. So look, have a good day, everyone. As I said, CPD will be coming out to you in the next week, and we really appreciate your attendance. Thanks again, Ruth and Mark.
Thank
Thanks,
you.
AFA. Thanks, Ruth.
Thank you.